Hey guys, Justin here. So today I want to talk about 3 simple investing mistakes that people make. And it's not only beginners who make these mistakes. I've been investing for over 10 years and have made hundreds of thousands of dollars through investing. But even I still make these mistakes from time to time. So whether you are a new investor or you have been investing for a long time, I think this video will be helpful to you. Now, just to be clear, the mistakes I'm about to reveal to you come from my own investing experiences, and I did not get this information from some generic article on CNBC. In fact, some of the things I will talk about in this video actually go against traditional investing advice. So I'm curious to hear your opinions and thoughts after you've watched the entire video. But first, if you are new here, go ahead and hit that subscribe button. It's really easy to do, and you will get notified whenever I release new videos, which is quite often. So with that, let's get into the first investing mistake that people make. The first mistake is not doing research before buying a stock. If you don't have the time or the desire to research companies, then you will probably be better off buying index funds. Buying index funds like the S&P 500 is the easiest way to make money in the stock market, and it's the easiest way because it requires no additional work. But when you start buying individual stocks, you have the responsibility to do research. And the goal of research is to determine if a stock will be able to outperform the index. Now, there are a lot of different methods for researching stocks, but at the end of the day, the main goal of doing research is to build conviction in the stock you are buying. And the higher the conviction, the more money you should be willing to invest. That being said, we will talk about risk management later in the video because it also plays an important part. But being able to build conviction in a stock is the most important thing in my opinion because it determines whether we will buy the stock or not. Now, when it comes to building conviction in a stock, there are 3 vital components. First, you have to understand what the company does. Second, you have to look for growth trends that the company can take advantage of. And third, you have to understand how the company stacks up against their competition. When done successfully, this allows you to build up conviction in the stocks you are buying. And more importantly, it helps you avoid buying stocks you don't believe in, which can be a critical mistake because the stock market is notoriously volatile. For me, I built a lot of conviction early on in one stock, which was Shopify. And because I did that, I was able to withstand many significant price drops without selling, which has meant that over the past 3 years, I have returned over 1,000% on my initial investment into Shopify. And I actually made a video specifically talking about this. So if you want to watch that video, I will link it above and below. Now, obviously, building conviction in a stock requires accurately assessing its future growth potential, which is more of an art than a science. So if you are buying stocks, holding them for long periods of time, and still losing money, then it is very possible that you are simply bad at analyzing companies. And it might be better for you to simply buy the S&P 500 and walk away. But I would say it is way more common for people to buy stocks without having done much research at all, only to sell off those stocks as soon as they drop or there is negative news. And I can guarantee you that if you are doing this with your investments, you are underperforming the market. So having the ability to buy and hold stocks for long periods of time is the easiest way to make a lot of money in the stock market. But it does require accurately assessing companies' future growth potential, which you will hopefully get better at the longer you invest. Now, the second mistake I want to talk about is one that actually goes against traditional investing advice. And this mistake is selling a stock because it's gone up too much. And this is usually referred to as profit taking. Now, if you consistently do this, then I can guarantee you that you are getting subpar returns. Now, there are a number of reasons that people do this, but I want to explain why it's actually a terrible idea. You see, traditional investing wisdom says that you should buy low and sell high, which is great advice if you and I had the ability to perfectly time the market, but we don't. The reality of listening to this advice leads to 2 very bad investing habits. One is that investors wait too long to buy stocks, and the other is that investors sell their winners way too early. The easiest way to maximize your investment returns is to find stocks of great companies, buy them, and hold them for very long periods of time. Now, clearly, if you buy stocks of bad companies, then buying and holding will result in you losing money, or it will at the least result in you underperforming the market. That's why the first part of this video is so focused on finding good companies to invest in the first place. But time and time again, I hear stories of investors who bought a great growth stock many years ago and missed out because they sold too early. Meanwhile, the stock kept going up after they sold it, and they lost the opportunity to make a lot of money. So what happened to these investors? Well, the short answer is they got scared. And the long answer is they didn't understand how the stock market works. See, many investors think that the stock market punishes winners and rewards losers. And this idea can mostly be attributed to the rise of value investing over the past 30 years. Value investing theory says that stocks that are overvalued will always come down, and stocks that are undervalued will always go up. And this line of thinking makes logical sense, but it is really hard to put into practice. And it causes investors to do dumb things like selling their winners way too early. The reality is that correctly valuing companies is very difficult to do because all companies are not created equal. A good example of this is Tesla. We hear analysts consistently argue about whether or not Tesla is overvalued, and based on who you listen to, you would get two very different answers. So don't think that successful investing is simply buying undervalued companies and waiting for them to go up. In my opinion, this is a very difficult thing to do and won't get you the best results. Also, it is entirely possible for stocks of high-growth companies to trade at very high valuations for long periods of time. Over the past 100 years, the S&P 500 has had an average price-to-earnings ratio of roughly 20. But if we look at a stock like Amazon, its average price-to-earnings ratio over the past 20 years has been closer to 100, which is 5 times more expensive than the S&P 500. And even right now, its price-to-earnings ratio is well above 100. So based on value investing, we would have avoided Amazon and bought the S&P 500 instead. But if we compare the returns for Amazon to the returns for the S&P 500, we can see that Amazon has vastly outperformed the S&P 500 over the past 20 years. So the reality of the stock market is that winners get rewarded and losers get punished. Or put another way, stocks that go up tend to keep going up, and stocks that go down tend to keep going down. So if I were to try and rewrite the buy low, sell high theory, instead of saying buy low and sell high, I would say sell your losers and buy more of your winners. In doing so, you will be limiting your losses and letting your winners make more money for you. Now, of course, stocks are constantly going up and down, so it is important to not determine your winners and losers on a day-to-day basis. But if you do have a stock that has gone down and keeps going down, and your losses are starting to pile up, then it might be a good idea to sell. The one caveat I will say before we move on, however, is to never sell your stocks when the entire stock market is down. This is because in times of economic recession, the best strategy is to resist the urge to sell and try to buy more if you can. So this last mistake is one that is very difficult to avoid, but still needs to be addressed. And that is correctly sizing your position in a stock. And really, what this boils down to is correctly determining the risk of each investment you make. Now, I could easily do an entire video on this subject alone, but I will keep it simple for this video. Risk management is a very important skill to learn, especially if you are a new investor. Oftentimes, new investors lose lots of money when they first get started out, and they lose money because they put too much of their money into high-risk investments. Now, high-risk investments are appealing because they bring with them the potential for higher returns. And this is appealing to new investors because they typically don't have a lot of money. So the idea of doubling your money in a day or becoming a millionaire in a year is sometimes too tempting to avoid. But the reality of risk management is that everyone learns about it at some point in their investing journey. And what I mean is that every single person who has invested has at some point lost money. And the bigger the loss, the more painful the lesson. Also, the truth is that investing in the stock market is inherently risky. And what I mean is that the stock market can go up and it can go down. And it can go down for long periods of time. Back in 2008, the entire stock market crashed, and it actually took 5 years for the S&P 500 to fully recover. So if you would have been forced to sell your stocks during that time to pay your bills, for example, you would have lost a lot of money. But those are extreme circumstances, and if you were able to avoid selling in 2008, you would have made your money back and then some. So really, when we talk about risk, the biggest risk in investing comes from buying a stock that drops and never recovers. Therefore, when buying individual stocks, it is important to realize that not every company will be successful. Some will go on to achieve great success, and some will go bankrupt. Therefore, the easiest way to avoid risk is to simply buy an index fund. But you don't watch my videos to get generic investing advice like that. In fact, it is very easy to beat the index funds by buying individual stocks. For me, I do 3 things to quickly analyze the risk of any stock. And this is by no means a comprehensive overview of risk analysis, but I've found it to be quite effective. The first thing I do is to look at the chart history. Stocks with long histories of strong performance will be the least risky, whereas stocks with very short histories or bad performance will be the most risky. Also, it's important to look at the volatility of the stock chart. Stocks with big price swings will be more risky, whereas stocks with a very smooth upward trend will be the least risky. Now, the next thing I look at is the market cap. Stocks that have lower market caps tend to be more risky, and stocks with higher market caps tend to be less risky. So without knowing anything else about a stock, simply looking at the market cap can tell you a lot. For example, a $200 million market cap stock will be much more risky than a $200 billion market cap stock. And the reason for this is that larger companies have longer track records. Now, for me, I consider any stock under $1 billion to be a speculative investment. That means I understand that I have a very high risk of losing money if I purchase such a stock. Also, it means that I do not put any more than 1% of my portfolio into such a stock. Very rarely, though, do I even buy a stock if it is under $1 billion market cap. This is because I actually prefer stocks in the $10 to $50 billion market cap range. And I prefer these smaller stocks because they have the potential to appreciate at a much higher rate than mega cap stocks such as Apple or Amazon. For Amazon to go up 100%, its market cap would have to double, which at a current market cap of nearly $2 trillion would be a hard thing to achieve in a short amount of time. Okay, the last thing I do when evaluating the risk of a stock is to determine what competitive advantages the company has. And this is not an easy thing to do, but it is important for a number of reasons. Companies with big competitive advantages can more easily fight off competitors, and they can protect their profit margins a lot better. Also, competitive advantages can apply to many different things. It might be a company's proprietary technology, or it might be the way they make their products. Also, it might not have anything to do with the company's products at all. Leadership is one of the areas that I routinely look at to find competitive advantages. In fact, a 2016 study by Bain & Company showed that companies where the founder stayed involved had higher annual returns than the S&P 500. And a good example of this is Apple. Today, Apple is the biggest publicly traded company on the stock market, but it wasn't always that way. In 1996, Apple was on the verge of bankruptcy when they rehired Steve Jobs as their CEO. And as CEO, Jobs was able to save Apple and put it on a path to becoming one of the world's most successful companies ever. So the point here is that when assessing risk, looking at the leadership is very important. And I could give you many more examples on this, Nicola, but I think you get the idea here. So those are 3 common mistakes that you would be smart to avoid. And I really believe if you can avoid making these mistakes, then you can make a lot of money in the stock market. But that being said, there is so much more to being a successful investor than just these 3 things. So if you want to learn more about investing, make sure to check out my channel. Also, make sure to leave a comment below with your thoughts on this video. You guys leave awesome comments, and I really enjoy reading each and every one of them. So with that, thanks so much for watching, and I'll see you guys in the next one.